Hello and welcome to Commodity Champions. I'm Manisha Gupta, and what a historical month it has been for the month of April, where we did see the crude oil prices touch a negative. We also saw the Indian markets introduce negative pricing for crude. MCX in the meanwhile has introduced huge margins amidst the volatility that we have seen in case of the crude prices. But from those kind of lows, we also have seen the prices stage a smart recovery. This is after many of the US producers already are scaling back operations. We saw that happen with Exxon, Chevron, a lot of shale oil companies as well. And the latest is that you also have seen ConocoPhillips now cut output by double on the weaker side. The sub-$20 levels for the US crude prices is not affordable for many of these oil companies, and we have seen that reaction come in from them. The oil companies from OPEC and allies also are expected to cut production from 1st of May, and many of these members already have started cutting production. A lot of economies are opening up, they are easing their lockdowns. Markets do believe that next 10 to 15 days is going to be quite volatile for the crude oil prices, but post that there is expectation of a consolidation, even a recovery going forward. Joining us are our guests then. We have with us Jonathan Bharat, who is CIO, Probus Securities, Tignan Sekhar, Director, Comtrends, Kunal Shah from Nirmal Bang. We also are joined by Narendra Taneja. He's an energy expert and also national convener at the BJP. Gentlemen, hi, and thank you so much on the show. I want to start with you, Kunal, first. What is your sense on the crude prices? Because what we saw happen with April was nothing short of historical. We made some records there. How are you looking at the crude prices from where they stand?
Yeah, what we saw in the month of April was something nobody can believe it, that a commodity price is going to minus 40 levels. So that is something. But the reason for the same is very simple, that a commodity which is having either surplus or deficit of 1 million or 2 on a daily basis, suddenly it starts having a surplus of 25 to 30 million barrels per day because of the drop in demand and also the increased production by the Saudi and Russia. So what we saw was purely a massacre, and we've seen that humongous correction in crude oil prices. But I think going forward, what is going to be a deciding factor is, like you rightly pointed out at the start of the show, we are expecting US crude oil production to drop by at least 1.5 to 2 million barrels in next 2 to 3 months. And at the same time, we are going to see, once the lockdown is moderated and things are resuming, at that time the demand will also come. And we are also going to see the OPEC production cut of 10 million barrels to start with from the month of May. So combining all these factors, it makes me believe that in next 15-20 days, it will remain volatile. It may get time to settle. But in the month of June, yes, we are going to see some recovery. June, July, I think we are going to see some sharp recovery. So I'm not saying that it will be $35, $40, but at the same time, the recovery to the tune of $24, $25 should not be ruled out in the month of July.
So we will see the crude prices come back above $20 in the month of June is an expectation. But Jonathan, what is your sense? It has been volatile. We are not out of uncertainty yet. Markets are scared about a slower recovery, a second wave of the virus perhaps. How are you looking at crude prices? What is your sense on the road ahead?
Manisha, good evening. Look, I generally feel that we obviously have got a low in place, and I think when I look at the way the economies will recover, and more importantly how confidence will recover, I think the confidence will recover a lot quicker than obviously the economies, and with that, that'll help to create a low in place. When I look at the price action, yes, we're consolidating. I think as economies start to come back on tap, demand will meet the supply. Remember, the US has already cut 900,000 barrels off its daily production, and expect more of those with OPEC coming as well. I certainly agree that prices have stabilised, will stabilise. There will be a couple of still volatility, but at the end of the day, I think prices will start to move higher from here, and probably see Brent back around that $30, $35 a barrel. When you look at the WTI contract for the December, it is trading $30 a barrel at the moment. So I think you can be quite optimistic that if you are a hedger, these are the levels which you should be buying at.
While expectation of a recovery in the second half is quite loud right now, but what is your sense on the near term, Jonathan? What kind of a demand are we looking at now for the month of May? Because April did see a huge demand destruction, but is the month of May also going to be equally painful?
Look, I get a concern when I look at the numbers coming, the economic numbers coming out of Europe, the economic numbers coming out of the US. They do look quite poor, and I think they'll remain poor for some time. And I think that'll weigh heavily on the speed of the recovery that we do find. But I think that the numbers will be negative, but I think the overall combination of confidence and supply cuts will help that market. So when I look at the price action, I still look for the month of May for it to be relatively volatile, but I certainly feel that we're in a range. When I look at the Brent contract, it'd have to be 28.30 on the top side and 22 on the downside. And once again, I think I'd be favoured to be on the buy side rather than the sell side of the commodity. And I think that's the way the market is playing it at the moment. Very rare, very nervous to sell on the top side, but more people are happy to support it on the dip.
I also want to get in a queue from T. Gnansekar. Gnansekar, what is your sense? Volatile crude prices. I also want to get a sense on what really happens now in the Indian markets in sense of prices, because we've seen the exchanges react to what the international markets have done. How is the trading here? How do you look at the volumes? And would you say that the exchanges perhaps need to step up faster on the reactions here?
If we have a contract which is basically mirroring overseas exchange price, I think we should pretty much mirror whatever is going on there as well. When NYMEX incorporated a negative price to their system a couple of weeks before a crash like this, we should be quick enough to take cues from that and do it as well. And technologically, we have all the software solutions to do that. So I guess that's where the critical thing is. If you're going to follow a overseas contract for direction and for price settlement, I think we must pretty much do everything what they're trying to do, or what they would do for from their side. So that's where the crux of the problem is, as far as the Indian market is concerned. So when you have equity markets trading in proper normal time, I think the commodity market should also be let do that. So suddenly curbing the time and all that has added to the issues overall. So my feeling is, I think market participants will certainly stay away from crude, as it is crude is volatile, and they would tend to stay away for some time till all the dust is settled. And I guess even the members would resist traders from taking positions in crude oil. So, from a number two commodity in terms of volume, I think it will very much come down the line. And maybe other commodities which are more stable would now be on top. But that's a very sad thing, because, crude has been number two in volume overall as far as the Indian markets are concerned. So it's a very liquid commodity suddenly becoming illiquid because of one freak instance. So it's pretty sad.
Well, yes, crude oil prices globally is the most liquid and the most traded commodities, and with the kind of volatile moves that we've seen come in for that, not just NYMEX, but Shanghai, India, Australia, we've seen various other countries actually struggle to keep up with the kind of volatile moves that we've seen for the crude oil prices. Mr. Taneja, I want to include you into the conversation as well. When it comes to the consumer countries, we've seen all of these countries actually try to fill up their storage reserves, making use of the weaker prices here. What has been India's strategy here? Because when we were talking in the previous week, we understood that 95% of India's storage had filled up by then. How are we looking at India's demand, India's reaction to lockdown, and the strategic reserve itself?
Well, first of all, you see what we saw, we have seen the last 4 weeks have been absolutely unprecedented, almost insane. In the oil sector, we have never seen anything like this before, like in 100 years. And of course, coronavirus was the trigger. But what after that was basically, that was again unprecedented. Saudi Arabia and Russia fighting in public. They'd never seen before. And the result was what it was. And the United States then chipping in. And the United States, Russia, Saudi Arabia, these three, oil superpowers coming together, for what? To push the prices up. And the result was just the opposite. Now they've agreed for, 9.7 million cut, but we also know they are actually targeting for 30 million barrels cut, in order to make sure that the prices do start moving northward. So we have to wait and see. But coming to your question on India, you see, in terms of oil storage and all that, we have got a very limited, capacity for that's about roughly 9 days. When we talk strictly of the strategic reserves, but if you're thinking in terms of, tank farms and refineries or the oil tankers and all that, then of course it's different. But that's actually you have to keep it out of when it comes to the strategic reserves. So we are, we consume roughly 5 million barrels a day, typically. I'm not, of course, talking the last 4 weeks. There the picture has been very different. We have seen demand destruction in the range of about 30%. When you look at the road fuels like petrol and diesel, we have seen demand destruction in terms of about 50%. And that's, again, unprecedented, absolutely unprecedented. But as you know, that over the coming few weeks, hopefully, the governments will be gradually lifting the, lockdown, and we will see the normal activities being resumed. And once that happens, I think the recovery is going to be only a matter of maybe a couple of weeks, not more than that. But again, it all depends on, once you lift the lockdown, how things go in terms of, spread of the coronavirus, and also spread of coronavirus in terms of, globally. So there are many questions there. And we are not, we are not alone. I mean, the whole world is facing more or less the same kind of dilemma. But my own sense is that being an importing country and heavily dependent on imports, these ultra low oil prices that we have seen the last 3, 4, 5, 6 weeks, are they good for India? My honest analysis, no, they're not good for India. If very ultra low oil prices means that, we lose projects in the Middle East, or people from there, they're left with no jobs and they have to come back to India, or the global economy suffers in terms of 3% drop in GDP and all that. So that's not a good news for India. The same way as ultra high prices are never good for India. If you go beyond $70 per barrel, that's not good for India. But so overall, looking at the picture, I think, I hope the next 3 months are going to be extremely volatile, extremely difficult. You will see some recovery. It depends on, again, the lockdown in India and other geographies. But I think, we'll have to wait and watch. But right now, we are with the world. We are more or less on the same boat as other countries. The only difference is India happens to be the only large economy which is more vulnerable in terms of oil security and oil supplies than any other country. Even China is only 50% dependent, while we are roughly about 86%. So we are more vulnerable, so we have to be extra careful.
Well, Mr. Taneja, you actually covered all the bases there, right from the pricing to the international markets to India. And of course, your point is very well taken that ultra low, ultra high crude price is not good for India. The volatility also is not good. We have to have crude prices in a range where it works well for overall global economy as well. Mr. Taneja, thank you so much for joining us with your sense there. We will take a very short break. We've spoken on the crude oil prices, the volatility there, but history has been in making for the gold prices as well, where we have seen all-time highs in gold prices many a times in the previous quarter, in the previous month as well. It has proven itself as a safe haven, as a must-have in your portfolio. What is the sense going forward onto that one is what we will discuss after this short break. Welcome back, and let's talk about gold now, where we did see record highs in the Indian rupees, in the euro and various other currencies as well, especially in the Asian markets. The gold prices have been running up on the back of stimulus measures that have come in from Japan, from US, from the European Central Bank as well. The lower interest rates in the global markets have been supportive, and gold actually is the best performing asset class in 2020 till time. We have seen nearly 13% of gains in the global markets and near 20% of gains in the Indian markets as well. Jonathan, what is your sense for the gold prices going forward from here? Near term, slightly longer term, the structural bull run that we keep talking about, is gold a part of that?
Manisha, look, I think gold is certainly a part of that. I think one of the concerns I have is that people, whether they're starting to buy gold as a basis of a safe haven, or whether they're buying gold as a result of inflationary pressures, which we haven't seen for such a long time. And I think that once we get that confidence coming into the market of a recovery, then I think the need for gold will change unless we start to see those inflationary pressures start to build. Now, we can't not expect to see inflationary pressures build with all the stimulus going on. So I think that in itself will support any dip. But I do think that in the short term, I think prices really need to try and get through that 1750 level. And if they break to that on the top side, likewise, 1650 reveals consolidation. That consolidation, I think, is limited until we start to see evidence that inflationary pressures are going to really start to be there. And one thing I do note is that when you look at the economic performances of the States and also of Europe, that will trickle and that will continue to be, I guess, weighted to the downside, whether a lot of the other economies in Asia will be weighted to the upside. So I guess it's when you look at the two, are we going to see economic concerns and people will stay to gold, or are we going to see inflationary pressures and people will keep on buying gold? I tend to think the latter, because of all the stimulus, that gold will be once again supported on dips. But let's see a break to that top side, and I would add 2 positions there.
Okay. So, Jonathan, if the gold prices do break above 1750, then what kind of targets are you working with? And the second part of my question really is about the buying side, because the World Gold Council report that was released in this week suggests that the international investment demand and the ETF demand actually has been the best in many quarters. How do you look at that buying pattern?
Well, I think when you look at the buying side of it, it's people who are nervous. But when you set the economies and when you set the fear, in another 2 to 3 months, we sort of have to look at how that will support prices. And I think that the fear is genuine that certain economies won't perform as well as other economies. But I do get a sense that at the end of the day, when you're throwing so much money, in stimulus at the economy, that prices will go up. We have seen already in a lot of the numbers from different countries around CPI, food inflation, all that seems to be picking up quite dramatically. And when you do see that, you get a sense that gold will be supported. It hasn't been a play for so many years when you look at gold and say it's an inflation fighter, but when you look at all the assets around, it is one true value, and that's held its value for most of this year. So I think more data that says inflation, the more chances we have that gold will be supported. Breaking through 70.50 sets the trend. I'm pretty sure back up through to that 1800, 1830, and then see what happens. But I think we've got a serious road or a serious focus on those inflationary pressures, and those inflationary pressures are here to stay for quite some time, and that will support the commodity.
All right, so you're betting more on the higher side than on the lower side, but yes, needs to see some important levels taken up. Kunal, I know we've been speaking and you have been bullish on gold. What is your sense from here on? We did see some profit taking as the week proceeded. How are you looking at the levels now, near term, slightly longer term as well?
In near term, we have been recommending that we are going to see some profit taking, and that is what is going on right now. So on MCX, we believe 44,000, 44,500 are kind of levels where one should really start going long again, or perhaps a tad lower from that 43,500. But I'm not expecting a sharp drop in gold prices. But at the same time, in near term, we are going to see some bit of profit taking. And another thing, another development which took place is that again, US President Trump is trying to escalate the trade war with China. So all these reasons are very bullish from the long-term perspective. The way central banks are printing, especially US. So we've seen US balance sheet expanding in last 1.5 months from $3.7 trillion to almost $6.75, $6.8 trillion. So by the end of the year, this number could reach to $7.5 to $8 trillion. So this kind of monetary easing we have not seen in the history of financial market. And that makes me believe that when the currencies are losing, the reserve currency is dollar, and the way they are printing the dollar, it seems that the dollar is going to lose its value. So going forward, not immediately, but maybe 3 months, 6 months down the line, we will see a sharp depreciation in the value of dollar, and hence gold remains a perfect hedge. And from the long-term point of view, I'm expecting on COMEX by the end of this year, gold to again retest $1,800. And by the end of 2021, it can test $2,000.
All right, so newer highs in store for gold. Gnansekar, I want to come to you with the Indian part of the buying because 1 month of a lockdown and we've seen the industry actually being shut. We've lost out on Akshaya Tritiya as well, and soon it would be monsoons again. You don't see too much of a rural buying coming in because the money actually goes in for sowing and other things. How are you looking at the demand recovery in the Indian markets? Because when it comes to physical buying, all the global eyes are on China and India for this one.
Well, I don't think there's going to be a demand recovery. In fact, it'll be demand destruction because most people would sell their gold to sort of resurrect their life. And, as a country, each household has been having gold as an insurance, for difficult times like this. So I think we can rule out any demand recovery in the next 2 quarters completely. But having said that, what we forget is the investment demand will more than compensate for all this demand destruction, even in India. Because, the Indian equity markets, the way it has collapsed and the way gold has steadily, given returns, will certainly push investors, even in the Indian markets, to move towards the safety of gold. So I think, we're clearly heading towards demand destruction in the next couple of quarters. And I'm pretty sure it will recover after that once, things have settled. But who knows if, the pandemic tends to continue or there is a second wave of it. I think then, gold prices, both domestic and internationally, can, rise quite sharply. Just a bit to touch upon the dollar weakness. I think, what we forget is the carry trade, which typically happens, when the dollar becomes, the interest rate becomes cheaper. The money will start chasing assets like gold, and same even asset like gold is going to be in huge demand, both in India and overseas. And let's not forget the US election uncertainty, which is going to start very soon. So that's going to play into gold. So my feeling is, all the corrections will be short-lived in gold, and will be great opportunities to buy. And I agree with your guest who talked about 1650, 1750 as a range. 1650 clearly is a very strong support. Anything closer to 43,000 is a good level to buy. We're clearly targeting 50,000 odd in the markets and possibly 1,900 or so by December.
All right, that's a bullish panel on gold, clearly. Jonathan, Kunal and Gnansekar, thank you so much for joining us today. So when it comes to the gold prices, dips are a good idea to buy. 1750, 1800, 1850 on the higher side in this year is perhaps where you could see the gold prices. As far as crude goes, some volatility in the month of May, but a smart recovery from June onwards is what our experts also believe the crude prices to display. With that, that's all the time that we have on Commodity Champions. Thank you so much for watching.